Let's talk about a company that does nearly $300 billion in business a year. It's so vital that if it stopped working, pharmacies and hospitals would literally grind to a halt. And yet, I'm willing to bet most people have never even heard its name, Cencora.
Well, Cencora is the answer to that question. It's the hidden giant of the pharmaceutical supply chain. And if you're an investor, its story is absolutely fascinating. It's this wild mix of incredible scale, a really dangerous paradox, and a huge bet on the future of medicine.
All right, so first, let's just try to wrap our heads around the massive scale of this nearly invisible giant.
Now, this isn't just about trucks and warehouses. Think of Cencora as the system's gatekeeper, the air traffic controller, managing this incredibly complex flow of medicine between thousands of drug makers and all the places you and I get our health care. They're making sure the right drugs get to the right place, safely, every single day.
And this is the result, almost $300 billion in yearly revenue. It's a business built on just colossal volume. But, and this is a huge but we're about to get into, that massive number is hiding a pretty dangerous secret about the company's actual profits.
So how is this business protected? For an investor, this is where things get really interesting. The company's power isn't just about being big. It's baked into the very structure of the market itself.
You see, the U.S. pharmaceutical distribution market is a textbook oligopoly. It's not some open, free-for-all market. No, it's a club, and it's controlled by just a handful of huge players.
Cencora, along with its rivals McKesson and Cardinal Health, they make up the big three. Together, they control something like 90% of the entire U.S. market. But look at this table. Specifically, look at the adjusted operating margins. They are all razor thin, hovering right around 1%. That tells you everything. This is a game of massive scale, not big profits on any single sale. These things all come together to create what investors call an economic moat, and it is a big one. To even think about competing, a new company would need billions in cash, just an army of lawyers and compliance experts, and somehow achieve massive scale on day one. It's pretty simple. It's a club that is effectively closed to any new members.
So a secure moat should mean smooth sailing, right? A safe investment. Well, this is where the story gets really tricky. We find this deep paradox right at the heart of Cencora's business model.
On the surface, things look fantastic. Revenue is growing at a really healthy double-digit clip, pushed along by an aging population and just a rising demand for all kinds of medicine.
But then you look a little closer, and you see the problem. The profit margin on all that new revenue is not only tiny, but it's actually shrinking. So how can sales be going up, but the profitability on each sale is going down?
The answer, believe it or not, lies with those blockbuster drugs everyone is talking about, the GLP-1s, like Ozempic. They are driving a ton of revenue growth for Cencora, but they come with a catch: lower profit margins. Think about that. Cencora's biggest growth engine is actively shrinking its own profitability.
Okay, so how does management fight back against this pressure on their margins? Well, they're making a high-stakes pivot, a bet that's designed to fundamentally change the whole company.
The plan is actually pretty clever. They're taking the enormous, predictable cash flow that their low-margin distribution business kicks off and using that money to buy companies in more profitable corners of the healthcare world, specifically service businesses. And this acquisition of RCA is the perfect example of that strategy in action. This is not another distribution company. Nope. It's a management services organization for specialty physician practices. This is a deliberate move away from just moving boxes into a much more lucrative pharmaceutical-centric service business, and it's all designed to boost Cencora's overall profit margin. But here's the risk for an investor. This kind of buy-and-build strategy is notoriously difficult to pull off, and Cencora itself just proved it, taking a major write-down on another company it bought, PharmaLex, because it was underperforming. It's a really stark reminder that this pivot, as necessary as it is absolutely not a guaranteed success.
So this brings us to the final verdict, which is a classic bull versus bear debate. You have two very compelling but totally opposite ways of looking at Cencora's future.
Okay, the bull case is pretty simple. You're betting on a powerful oligopoly that's using its massive cash flow to intelligently pivot into more profitable businesses. The bear case, though, argues that the company is running against a ticking clock. You've got this relentless margin pressure from GLP-1s, you've got high risk on their acquisition strategy, and you have a stock that's already trading at a premium valuation. That's a recipe for disappointment if the pivot isn't perfect.
So this is it. This is the multi-billion-dollar question for any investor. Cencora is in a race against itself. Can its new high-margin strategy grow fast enough to outrun the margin erosion that's happening in its massive core business? The answer to that question will determine whether this healthcare giant soars or if it gets weighed down by its own success.